Imagine logging into your banking app on Tuesday morning. You check your mortgage balance, and you realize you owe the bank $50,000 more than your house is actually worth.
Oh, wow. Yeah, that is a terrifying thought.
Right. I mean, if you tried to sell it today, you would literally have to write the bank a check just to hand over the keys.
Exactly.
And that is the terrifying reality facing thousands of Australian first-home buyers right now in 2026.
It is, it's a brutal paradox, really. We are looking at a market that is dropping at record speeds, yet somehow property is feeling less affordable than ever before.
Yeah, and that is exactly what we are tearing into today. We are doing a deep dive into this bizarre disconnect in the Australian property market, and we are pulling from a massive stack of highly timely sources for this one.
Oh, definitely. We've got major bank forecasts from CommBank and ANZ, monetary policy statements from the Reserve Bank of Australia, and expert market analysis from places like Cotality, WBP Group, CanStar.
Plus Loanworks, Property Buyer, and DPN. It is a huge stack of data.
It is a wealth of data. And what is so crucial about these sources is that they let us look under the hood. You know, we aren't just looking at the plunging prices, we are looking at the actual mechanical levers pulling them down.
Exactly. Because the rules of the game just fundamentally changed. And today's mission is to figure out why a supposed discount in house prices is actually trapping buyers. Plus, how sweeping new tax laws are rewriting the structural DNA of investing.
Yeah, and whether sitting on the sidelines, waiting for prices to hit rock bottom is actually going to cost you more money in the long run.
Right. So by the end of this deep dive, we want to help you figure out the ultimate dilemma for your own situation. Do you buy now or do you wait?
To even begin answering that, though, we have to separate the short-term weather from the long-term climate change, so to speak.
Oh, I like that analogy.
Yeah, because the headlines are screaming about interest rates, but the structural climate of Australian real estate was just permanently altered by the 2026 federal budget.
Okay, let's unpack this. Before we look at why prices are dropping today, we have to understand these new rules. The 2026 budget essentially dropped a bomb on how residential property investment is taxed.
It really did.
And these changes take full effect on July 1st, 2027.
Right. The landscape has been radically altered. The government specifically targeted two foundational pillars of Australian property investment. That's negative gearing and the capital gains tax, or CGT.
Let's start with negative gearing, because for decades, that has been the sacred cow of property investing here. Let me make sure I have the old mechanics right just to set the baseline.
Sure, go for it.
Under the old system, if you owned an investment property and your mortgage interest and maintenance costs were higher than the rent you collected, you took that loss and immediately subtracted it from your day job's salary.
Right,
So
exactly.
it lowered your taxable income, meaning you got a bigger tax refund that year.
That is the traditional mechanism, yes. It provided immediate, real-time cash flow relief to property investors.
Well, not anymore.
No, not anymore. From July 2027, negative gearing is being strictly restricted to new builds only. So if you buy an established home, a house that already exists after the budget announcement date, you can no longer deduct those net rental losses against your regular income.
Wait, so what happens to that money? Like, if I am losing $10,000 a year on an older investment property, does the government just pretend that loss didn't happen?
Not entirely, but its immediate value vanishes. The new policy mandates that these losses are quarantined.
Quarantined.
Yeah, they are locked away and carried forward, so you can only use those losses to offset future income generated strictly by residential rentals. Or you can deduct them from your capital gains when you eventually sell that specific property years down the line.
I mean, that is wild. I am bleeding cash today, but I get a tax perk a decade from now. That completely destroys the cash flow strategy for everyday investors.
It absolutely does, and CommBank actually put a number on this in the sources.
Oh, really? What did they say?
They estimate that losing this immediate deduction is equivalent to a 90 to 155 basis point increase in investor mortgage rates.
Okay, we should probably translate what those basis points mean in reality.
Yeah, fair enough. So 100 basis points is exactly 1%. CommBank is saying the cash flow hit from this tax change feels the exact same as your mortgage interest rate jumping by 1 to 1.5%.
Oh, wow.
Yeah. So if you have a $600,000 loan, a 1% increase is an extra $6,000 a year out of your pocket.
Just gone.
Just gone. That is money you suddenly have to find every single year to keep the property afloat without that immediate tax shield.
Which is a massive burden to carry.
Yeah.
And then there's the other shoe dropping, which is the capital gains tax.
Right.
Under the old rules, if you owned a property for more than a year and sold it for a $100,000 profit, you got a 50% discount. You only paid tax on $50,000.
But that 50% discount is gone now. Under the new system, the cost base of your property will be indexed for inflation, and then you pay a minimum 30% tax rate on the real gains above that inflation.
That seems huge.
Well, Combank points out this isn't universally worse. Like, if your property only goes up in value very slowly, roughly matching inflation, you might actually pay less tax.
Okay.
But if you see massive booming price growth like we did in the early 2020s, this new system takes a much bigger bite out of your profits.
Right. Is this essentially like changing the rules of monopoly halfway through the game? Like, let's say you already own the Boardwalk Hotel. The sources mention a grandfather clause, meaning you are completely fine.
Yeah, that's a good way to put it.
But if I want to buy a house there tomorrow, I am playing by a much harsher, penalized set of rules.
It is a two-tiered system now, for sure. Any existing investment properties held before May 12, 2026 are grandfathered. Those owners get to keep the old negative gearing and CGT rules for as long as they hold the asset.
It must be nice for them.
It is. And if we connect this to the bigger picture, we have to look at the government's intent here. They aren't just tweaking numbers for fun. This is a deliberate policy designed to redirect capital.
Because they want to fix the housing crisis.
Exactly. They want to make buying existing older homes financially unappealing to investors, thereby forcing that investment money into financing brand new housing supply. The overarching goal is to build our way out of the housing shortage.
But wait, if I'm an investor holding a grandfathered property and I have these golden tax perks that nobody else can ever get again, why on earth would I ever sell?
You wouldn't, or at least you would be heavily disincentivized to do so. Economists call this a lock-in effect.
A lock-in effect. So people just hold on for dear life.
Current owners will absolutely hoard those properties, and when people refuse to sell, the turnover in the market grinds to a halt. Combank's modeling suggests these combined tax changes will slowly depress the price of established homes by about 3% over time, simply because investors are no longer bidding on them.
But there is a nasty side effect to that. If investors aren't buying established homes, they aren't renting them out either.
Precisely the issue. The supply of established rental properties drops. And Treasury estimates this contraction in rental supply could push weekly rents up initially by about $2 a week.
Which doesn't sound like much.
It doesn't, but other analysts think it could be much higher as population growth continues and supply stays tight.
Right. And a quick, critical note from the sources for anyone listening who is holding on to one of those golden grandfathered properties, WBP Group stresses that getting an independent, professional property valuation is absolutely critical right now.
Oh, absolutely.
You need a rock-solid, legally compliant baseline of your assets' value before the new tax era officially begins in July 2027. You cannot afford to guess what your property was worth on the transition date.
No, you can't. Documentation is going to be the difference between keeping your wealth and handing it over to the tax office.
Okay, so if those new tax laws are the long-term climate change cooling the market over the next decade, the current interest rate environment is like a Category 5 hurricane tearing the roof off right now.
The Reserve Bank of Australia has held the cash rate steady at 4.35%. And when you combine the psychological dread of the incoming tax changes with the very real mathematical pain of a 4.35% cash rate, property prices are being pulled down violently.
The numbers from Cotality in our sources are just staggering. This isn't just a localized dip in a few overpriced, ritzy suburbs. It is a national downturn.
Yeah, the data is very clear.
Over the June quarter alone, Sydney values fell 3.2% and Melbourne fell 2.6%. We're talking about over 3/4 of all capital city suburbs recording a decline.
And the major banks' forecasts suggest the floor is still a long way off. ANZ is predicting a massive peak-to-trough drop. They forecast a 14.5% total decline in Sydney.
Wow, 14.5%.
To put that into perspective, that would wipe roughly $236,000 off the median house price. Melbourne is facing a 12.8% drop, erasing about $127,000.
Here's where it gets really interesting. If I am a young first-home buyer who has been locked out of the market for years, and I hear that Sydney houses are suddenly on sale for a $236,000 discount, I should be thrilled, right? Why aren't buyers flooding the open houses?
Because that discount is an illusion.
Illusion.
Vendors aren't dropping their prices because they want to. They are dropping them because buyers physically cannot get the money from the banks to pay any higher. Duotax highlights that with the RBA cash rate at 4.35%, the bank's stress testing is incredibly strict.
Right. This is what the sources call the serviceability buffer. Explain how that works for us.
When you apply for a mortgage, the bank doesn't just calculate your ability to repay the loan at today's interest rate. The regulator forces them to add a buffer, which is usually around 3%, on top of the current rate.
So they pretend the rate is higher than it actually is.
Exactly. So if the bank is offering you a 6% mortgage, they calculate your application as if you were paying 9%. And because interest rates are so high right now, that 9% stress test is causing buyers' maximum borrowing capacity to absolutely plummet.
So the house is $200,000 cheaper, but the bank is offering me $300,000 less than they would have 2 years ago. The house is cheaper, but I am actually further away from affording it.
Exactly the paradox. And this dynamic creates a terrifying trap, which CanStar brings up regarding the first home buyer 5% deposit scheme.
Wait, I thought that scheme was supposed to be the ultimate lifeline. Like, you only need a 5% deposit, and the government guarantees the rest, so you avoid paying lenders' mortgage insurance, which usually costs thousands of dollars.
That was the idea, yeah.
Loanworks even noted that back in late 2025, the government removed the income caps on this scheme, opening it up to almost everyone. So how is a government lifeline a trap?
It comes down to the math of a falling market. Let's walk through a scenario just to make it clear.
Okay, let's hear it.
Imagine you use that scheme to buy a median-priced home for $1 million at the peak of the market in early 2026. You put down your 5% deposit, which is $50,000. You borrowed $950,000.
Right, standard scenario.
Now, let's apply ANZ's forecast. The market drops by 14.5%. Your house is now worth $855,000.
But my loan is still for $950,000.
Yes. You are in negative equity. Your house is worth $95,000 less than the debt attached to it.
That's devastating.
CanStar warns that by mid-2027, thousands of buyers who utilize this scheme will owe the bank far more than their property is worth. If you lose your job and are forced to sell, the sale of the house won't even cover the mortgage.
So you'd have to find tens of thousands of dollars just to clear the debt to the bank.
Right. The very scheme designed to get people into the market is trapping them in a financial prison.
That is genuinely frightening. So we have high rates crushing borrowing power and plummeting prices creating negative equity traps. But let's look forward, right? The RBA isn't going to keep rates at 4.35% forever. Eventually, inflation cools, and they will cut rates.
And before we talk about a national recovery, we really have to address a massive anomaly in the data.
Okay, what is it?
Property Buyer points out that we are operating in a multi-speed market. While Sydney and Melbourne are bleeding out, Perth is actually up 22.5% over the year.
Wait, stop right there. 22.5% up.
Up, yes.
If interest rates are a national RBA policy, how on earth is Perth entirely immune to the gravity pulling Sydney down? Are they operating in a different economy?
In many ways, yes. It proves that local supply and demand fundamentals can completely override national borrowing constraints.
That's fascinating.
Perth has massive interstate migration, an incredibly strong local resources sector, and crucially, a historic undersupply of homes.
Right, supply and demand.
There are simply more people with high incomes needing houses than there are roofs to put over them, so prices surge regardless of the interest rate. Meanwhile, the data shows Sydney prices are currently a staggering 66% higher than Melbourne's, primarily because Melbourne has built a lot more supply in recent years.
So the fundamentals definitely matter. But let's assume the RBA does cut rates, which the sources suggest might happen in the second half of 2027. Both Duotax and Property Buyer warn that rate cuts act as an instant adrenaline shot to affordability.
Oh, absolutely. Because the moment the RBA cuts the cash rate, that strict serviceability buffer we talked about earlier, it starts to relax.
So the bank eases up on the stress test.
Yes. Suddenly, the bank will lend you more money. Your monthly repayments drop.
And this is where Rich Harvey at Property Buyer makes a really fascinating observation about human behavior. He notes that during a downturn, buyers hesitate. They procrastinate. They sit on their hands, trying to time the absolute bottom of the market to squeeze out a final, say, 3% discount.
What's fascinating here is the hidden cost of waiting. It is never truly free to sit on the sidelines and wait for the bottom.
No, it's not.
Property Buyer highlights that while you wait for house prices to drop, you still have to live somewhere. And the sources show rents are currently climbing at 6 to 8% annually.
So if you are that procrastinating buyer, you aren't just waiting. You are bleeding capital every single week in rent. The income side of the property equation is doing incredibly well if you're a landlord, but it is financially punishing you if you're waiting to buy.
That's right. And the second, more explosive part of this equation is the supply side. Think back to that lock-in effect we discussed with the budget tax changes.
Where nobody wants to sell their grandfathered properties.
Exactly. Vendors are refusing to sell. Plus, everyday homeowners look at the weak market and simply pull their listings. There is a massive contraction in new housing stock coming onto the market right now.
So we have incredibly low stock,
Right.
and then the RBA cuts rates.
It acts like a snapped rubber band, borrowing power surges overnight. All those procrastinating buyers who've been sitting on their hands for 18 months rush back into the market simultaneously.
Just a stampede.
Right, and they hit a market with historically low levels of homes for sale. A massive surge in demand meeting severely constrained supply will rapidly drive prices right back up.
As Rich Harvey says, markets turn upward just as quickly as they turn down. By the time you read a headline confirming that the bottom has passed, you are already sprinting into an open house alongside 50 other desperate buyers, and you're paying a premium.
Timing the absolute bottom is a fool's errand. You only ever see it in the rearview mirror.
So what does this all mean? We've talked about the new budget rules destroying the cash flow of established homes, high rates crushing current prices, the terrifying trap of negative equity for 5% deposit buyers, and the looming rubber band snap of future rate cuts.
It's a lot to process.
It really is. If you are listening to this right now trying to make a life-altering financial decision, it feels like buying property right now is like trying to catch a falling knife while wearing oven mitts. Like, you might get an amazing deal, but you have to be incredibly careful.
That is a very accurate assessment. Let's synthesize exactly what the data is telling us about whether you should buy now or wait. Because the answer isn't a blanket rule. It entirely depends on your personal financial footing.
Okay, let's start with the case for waiting.
If your finances are fully stretched, meaning you are maxing out your absolute borrowing limit just to get in the door, or if you're relying heavily on that 5% deposit scheme, the data screams at you to wait.
Because of that negative equity trap.
Yes. CanStar's warning is mathematically inevitable if the market continues to drop. ANZ shows cities like Sydney and Melbourne still have further to fall. If you have no cash buffer to absorb a 10% drop in your home's value, forcing a purchase right now is reckless. You need to wait out the storm to protect whatever equity you have.
But on the flip side, DPN makes a highly compelling case for buying right now.
They do.
High interest rates create a fantastic environment for prepared investors. Because the vast majority of the public is frozen by fear or locked out by those strict bank borrowing limits, you have drastically less competition at open houses.
That gives you unparalleled negotiating power with vendors who are desperate to sell.
Plus, DPN notes that because property prices have dropped but rents have surged, gross rental yields have hit 3.56% across the combined capitals. That is the highest yield return we have seen since 2019.
Wow.
DPN even drops the classic Warren Buffett quote, "Be fearful when others are greedy. Be greedy when others are fearful."
It's a cliche in finance, sure, but it holds true. Right now, you can snag quiet, off-market deals before the rate cut frenzy begins. If you have the capital, a healthy deposit, and a long-term strategy of 10 years or more, the lack of competition makes it a prime time to buy.
Especially if you are looking at markets like Melbourne, which, as we discussed, are historically incredibly cheap compared to Sydney right now.
Exactly. Your decision shouldn't be based on headlines. It should be based on your serviceability buffers and your own personal runway.
This has been a wildly enlightening deep dive into a very turbulent market. But before we wrap up, I want to leave you with a final thought to ponder. We've spent this whole time looking at the math, the basis points, the yields, the tax laws, but step back and look at what this means for the actual physical landscape of Australia.
This raises an important question about the very fabric of our neighborhoods, really.
Exactly. With the 2026 federal budget actively penalizing investors for buying established homes and explicitly forcing all that investor money into new builds just to chase those tax exemptions, what happens to the great Australian dream?
That is the million-dollar question.
If the only way an investor can make the math work is by funding new, high-density townhouses and towering apartment blocks. The traditional quarter-acre block with a classic detached house might shift permanently out of reach for the average person.
It's very possible.
As capital flows aggressively into density, the look, the feel, and the skyline of Australian suburbs might be completely, irreversibly redefined over the next decade.
The rules of the game have changed, and the board itself is going to look profoundly different.
Next time you walk down your street, take a look at the older houses around you and wonder what that exact street will look like in 10 years when the new tax incentives have reshaped the concretes. Thank you for joining us as we navigated the turbulent, falling knife mechanics of the 2026 property market. Until next time, stay curious and happy exploring.